The IRS quietly changed 3 housing rules that directly affect your money, and most homeowners have no idea any of it happened. Not because the rules are complicated, because the IRS does not announce these things to you. They update the guidance, they shift the enforcement posture, and they wait. Your tax liability adjusts quietly in the background while you go about your life assuming nothing changed. That is not how this system works. Today, I am going to walk you through all 3 changes, what they mean in real dollar terms, and exactly what you need to do before your next tax filing. Stay until the end. The 3rd change is the one most homeowners are completely unprepared for, and it involves money you already thought was settled. If you are not subscribed yet, do that right now and turn on the bell. Tax rules change every single year. When they change, nobody explains what it means for your specific situation. I am no expert, but on this channel, every week I cover the real financial information that affects seniors directly. The rules that changed, the protections you already qualify for, and the steps that actually make a difference. This is exactly the kind of content I put out every single week, and you do not want to miss it. If that's the kind of information you want to hear, then make sure to hit subscribe and turn on notifications right now. Now let's get into it. The IRS does not need an act of Congress to change how a rule affects you. They do it through administrative guidance, revised thresholds, updated enforcement priorities, and reinterpreted standards. These adjustments do not make the evening news. They do not show up in your inbox. They appear in IRS publications, revenue procedures, and internal audit selection criteria, and they take effect whether you read them or not. The homeowners who get caught are not the ones who did anything dishonest. They are the ones who assume the rules they learned 5 years ago still apply exactly the same way today. That assumption is costing people real money right now, and we will get to the 3rd change at the end, because that one involves homeowners who believe a financial matter is already closed, and behind them, it is not. If you're 65 or older, or you've got a parent who is, 3 rules just changed that could put real money back into your household, and barely anyone has explained them clearly yet. There was no big announcement, no letter in the mail walking you through it step by step. These changes got folded into massive legislation and a Social Security law that most people only heard about in passing. 2 of these changes mean extra money you may already qualify for right now. The 3rd one is bigger than most people realize. For some retirees, it can reshape their entire monthly check. A good chunk of what we're covering today traces back to a massive 2025 tax law, nicknamed the One Big Beautiful Bill, plus a separate law called the Social Security Fairness Act. Different bills, same theme. Quiet changes that are already affecting checks and tax returns right now, whether you've noticed or not. Let's get into the 3 biggest ones. Rule 1, the new senior bonus deduction. Rule number 1 is a brand new tax break that didn't exist before 2025. People are calling it the senior bonus deduction. Here's the setup. Seniors have always gotten a slightly bigger standard deduction than younger filers, an extra couple $1,000s tacked on once you hit 65. That part isn't new. What is new is a completely separate additional deduction layered on top of it. If you're 65 or older by the end of the tax year, you may qualify for an additional $6,000 senior deduction if you're single, or $12,000 if you're married filing jointly and both spouses qualify. Under the 2025 tax law, OBBA, this is an above-the-line deduction, meaning eligible taxpayers can generally claim it without itemizing deductions. It's available for tax years 2025 through 2028, making it a temporary benefit, unless Congress extends it. Let's put a number on it. A single senior with modest retirement income could realistically shield close to $24,000 from federal tax once you stack the base standard deduction, the existing age-based add-on, and this new bonus together. For a married couple, where both spouses qualify, That combined shield can run well past $40,000. For a lot of retirees living on a fixed income, that's the difference between owing the IRS something and owing nothing at all. There are important income limits, though. For single filers, the deduction begins phasing out once your modified adjusted gross income exceeds $75,000 and phases out completely by $175,000. For married couples filing jointly, the phase out begins at $150,000. And remember, this is temporary under current law, applying only for tax years 2025 through 2028. Because the IRS can update forms and guidance, it's always a good idea to verify the latest Schedule 1A instructions before filing or relying on this deduction. One more detail people miss: this deduction can also indirectly lower how much of your Social Security benefit counts as taxable income, since it reduces your overall adjusted income. It doesn't erase Social Security taxation entirely. That rule where up to 85% of benefits can be taxable is still on the books, but it can meaningfully soften the hit. Action step. If you're 65 or older, check that your tax preparer or software actually applied this new deduction. It typically shows up on an updated senior tax form with a supporting schedule. Don't assume older software or an outdated checklist caught it automatically. Rule 2. State property tax relief programs. Most seniors never claim. Rule number 2 isn't a single federal law. It's dozens of state-level programs that quietly exist in nearly every state. And most eligible seniors never apply for them. These typically fall into a few categories. Homestead exemptions, which shrink the taxable value of your home once you hit a certain age. Circuit breaker programs, which cap your property tax bill relative to your income. So if your income is fixed but your home's value has climbed, you don't get squeezed out. And senior freeze programs, which lock your assessed property value in place, so rising home prices in your neighborhood don't quietly drag your tax bill up with them. Here's why almost nobody uses these. They're not federal, so there's no single IRS form or nationwide announcement. Every state runs its own version with its own program names, income limits, age requirements, and application deadlines, usually through your county assessor, tax office, or state revenue department rather than the IRS. Before relying on any specific program, always confirm the current eligibility rules, income limits, and filing deadlines for your own state, since they can change from year to year. If nobody tells you it exists in your specific state, you simply never hear about it. And the money involved isn't trivial. Depending on your state and your home's assessed value, some of these programs can knock hundreds, sometimes thousands of dollars off an annual property tax bill. For someone on a fixed retirement income, that's often a bigger real dollar impact than a lot of the federal tax breaks people spend more time talking about. So here's what I want you to do. The benefits, the discounts, the assistance programs most seniors qualify for but never actually use. I gathered them all in one spot, organized by state and by program, so you don't have to dig through confusing government websites for hours. It's quick, it's straightforward, and any senior can find exactly what fits their situation. No matter what state you're in, there's help out there you're probably leaving on the table. It's called the Senior Exempt PMPPAKA, and it's sitting in the first pinned comment right under this video. Just tap it once and you'll have everything you need. Now stay right here, because the last one isn't a tax deduction or a local exemption at all. It's a change to Social Security itself, tied to public pensions, and for the retirees it applies to. It can be the single biggest jump in their monthly check they'll ever see. Almost nobody applying for a pension ever thinks to ask about it. So let's make sure you're not one of them. Rule 3, the pension-linked Social Security rule that got repealed. Rule number 3 is the big one, and it specifically affects retired teachers, firefighters, police officers, and other public employees whose pension came from a job that didn't pay into Social Security. For decades, two obscure provisions, one called the Windfall Elimination Provision and the other called the Government Pension Offset, quietly shrank or completely wiped out Social Security benefits. For people in exactly that situation, if you spent part of your career in a public sector job with its own pension system, and part of your career or your spouse's career paying into Social Security, these rules assumed you didn't need the full benefit and cut it down, sometimes to nothing. That's gone now. The Social Security Fairness Act, signed into law on January 5th, 2025, repealed both the Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO, with the repeal applying retroactively to benefits beginning in January 2024. The Social Security Administration has already processed millions of adjustments and paid out billions of dollars in retroactive lump sums to people affected by this. Here's what that means in real numbers. According to estimates from the Social Security Administration and the Congressional Budget Office, people affected by WEP have seen average monthly increases of roughly $350 to $360, although the exact amount depends on each person's work history and earnings record. Those affected by GPO, especially spouses and surviving spouses whose benefits had been reduced or eliminated, have seen average increases ranging from about $700 to as much as $1,190 per month, depending on their circumstances. These figures are averages and estimates, not guaranteed amounts, because every retiree's benefit calculation is different. For some people who had been receiving little or no Social Security because of the old rules, the increase can still be dramatic. This is precisely the kind of change nobody applying for a pension ever thinks to ask about. Because it isn't about the pension itself, it's about how that pension used to quietly cancel out a completely separate benefit you were also entitled to. If you retired from a job like teaching, firefighting, or law enforcement, or if your spouse did, and you never revisited your Social Security benefit after this law passed, there's a real chance you're still being paid the old, reduced amount, action step. Log into your Social Security account online and check whether an adjustment was already applied to your benefit. If you believe you're affected and haven't seen a change, don't assume it was handled automatically. Follow up directly, because the agency has acknowledged that some of the more complicated cases are still being processed by hand rather than automatically. Step back for a second and you can see the pattern across all three of these. The senior bonus deduction quietly shrinks what you owe the IRS, but only through 2028. The state property tax programs quietly shrink your local tax bill, but only if you know your state's specific program exists and actually apply. And the Social Security Fairness Act quietly restores money that should have been in certain retirees' checks all along, but only if you check whether it was actually applied to you. Notice the theme. None of these three things happen automatically just because you turned 65 or filed a return. Every single one of them requires you to actually go check, apply, or confirm. That's exactly why they're described as quiet. The money's there, but nobody's going to knock on your door and hand it to you. This isn't a substitute for sitting down with a tax professional or a benefits counselor who can look at your actual numbers, especially with income phase-outs and state-specific rules in play. But knowing these three things exist means you walk into that conversation already asking the right questions instead of finding out about them years too late.